fourth quarter review for equity funds. And as I said, it was really a strong quarter. It was a great year. When I say strong quarter, really it's going to end up being, only about 2% for the quarter, but really a great year and kind of fun to talk about. But it's interesting that I can kind of nail this down. I won't go through this in great detail, but I can nail this 3-month episode down to about 4 or 5 basic points. First of all, investors were climbing the wall of worry. No matter what came out, we had good housing numbers, we had better than expected employment numbers, and the like. Just things looked well, and investors did not want to participate in equity. So from when Matt gets on the line later on, he'll talk about the flows not going into equity funds, despite having a very good period of time. Again, if we take a look at the employment numbers, in October we saw a 7.8% unemployment rate. That was the first time it dropped below 8% since the president took office 4 years prior to that. It went to 7.9% and then dropped down to 7.7%. So overall, employment numbers have been looking pretty good. Again, investors ignored good economic numbers, but the market did have the ability to rally. If we look at November in the middle of the month, obviously we had some good news from Germany. The IFO numbers came out. China also had some pretty strong numbers with their purchasing managers index, so that was encouraging from a global perspective. And of course, we had better than expected sales for Black Friday and Cyber Monday. So overall, we had some really good numbers. And one of the continuing themes throughout all 3 months is we saw commodities take it on the chin. If you remember back to Q3, I talked about corn and the like, and people actually just giving up because prices were just too expensive. Well, now what we saw in the commodities market is we saw a decrease in demand. Oil, people didn't want to necessarily purchase oil. It was because of the supply and demand issue. Obviously, China was cooling its jets, and the global economy was heading into a recession if you look at Europe as a whole. But basically, the demand for commodity was on a decline. And then also what we saw was that there was bumper crops in both coffee and sugar out of Brazil that knocked down the price as well. So really, one of the continuing stories is how poorly the commodities and even precious metals did during this period of time as well. So again, I'm not going to go into great detail other than saying that for October we had our negative performance, and then if we take a look at November and December, they were actually really good numbers, 2.09% in December, with 91% of all equity funds posting returns in the black. One of the things that we talked about was that wall of worry, and here are the 3 things that people were looking at. Obviously, the upcoming presidential election, that's done and over with, but people were still concerned then about whether the fiscal cliff would be taken care of. And last, of course, we've all had our eyes on the European debt issues, and I think the biggest issue was the fiscal cliff and people keeping their eyes on it. But fortunately for us, the Fed, the European Central Bank, and the People's Bank of China all became very accommodative and very, very loose with their money requirements. So we had interest rates for the People's Bank of China drop to 6%. We saw the ECB drop their prime lending rate to 0.75%. So this was just good numbers forcing us, again, don't fight the Fed or any other of its community members. Don't fight the Fed, and it was really pushing people towards riskier assets, and that's the story that we got to tell today. So let's go ahead and move on to the fourth quarter as a greater review on equity funds. They gained about 2.01% for Q4. And given the improved views of the European debt crisis, and also taking a look at the concerted efforts by the Feds, as I just mentioned, basically we saw world equity funds jump to the head of class, 5.45%, basically overshadowing any of the other equity groups. Mixed asset funds came in with about 1.33%. USD funds were able to put together a 0.85% return, and sector equity funds only 0.31% return. But keep in mind now, when we're talking about USD and sector equity funds, again, sector equity funds got crushed by the commodities. USD funds really got taken down by dedicated short bias funds during that time period. So it wasn't as dismal as it looks, and again, 2.01 for the fourth quarter is really quite good considering how we ended up. Let's jump right down to the bottom. Great year, 14.51% return for equity funds overall. That's certainly something to write home about. If we take a look at the quarterly leaders, China, it would be the unsuspecting groups that we actually had. China region funds, international real estate funds, global financial services funds, those funds paying dividends and having that international flair. 2 things here: dividend payers and also out of favor stocks and funds were doing better. So we saw European region funds up 7.66%. Again, global financial service funds up 8.55%. At the bottom, we saw gold, which was Q3's leader, by the way, take it on the chin, down 12.49%. And of course, commodities, precious metal, that's CMP, down 7.55%. And commodities, agriculture, taking it on the chin as well, 6.62%. So we saw that the pound and the euro actually lost, or the dollar lost ground against the pound and the euro, but gained against the yen. And this is a story that I think we should keep an eye on. 11.02% is basically what we gained against the yen. And that tells me that, from an export society, a weakening yen would actually be in favor for them and also maybe cause a little bit more activity in their markets. At least I think that's what people are hoping for. Again, commodity prices were down. Gold was down 5.44%. Oil lost just a little bit, 0.4% from its Q3 ending value. So overall, we had good numbers. 69 out of 90 classifications in the equity universe were on the plus side. So let's go ahead and take a look at our United States Diversified Equity Group. And this, for the first quarter since Q1 2010, we saw that small cap value funds rose to the top and did better, 3.84%. One of the things I failed to mention during the introduction is we saw some kind of discouraging news in October and November about Apple, about Microsoft, about Google, some other technology firms. And so overall, we saw a downturn in the global growth focus, with these tech firms. And so really the story that we had was value came into favor and has been into favor, again, if we take a look at the follow-on months. But for the quarter, small cap value up 3.84, mid cap value 3.81, and again at the bottom, we saw large cap growth funds down 1.01%. Again, that was dragged down. We'll talk a little bit more about that by technology. And of course, anytime you have some good performance, dedicated short bias shows up as a bottom performer, down 3.36%. So in December, basically, United States Diversified Equity Funds edged out mixed asset funds, which only returned 1.17%. So overall, December, it was kind of a slow period of time. Diversified leverage funds were up about 4.57%. And of course, value, again, was one of the, favors or flavors of the month. Value came in very strong. Year to date, the USDE funds were up 13.87, the second best performing macro group. And ironically, as we probably know on a year-to-date basis, dedicated short bias funds, when anything's strong, dedicated short bias is on the bottom. Keep in mind that might have dragged down the United States Diversified Equity Funds group. Dedicated short bias funds for the year were down 23.58%. For those people sitting on the sidelines or making bets against the market, they really took it on the chin for the year of 2012. Our next group, basically, taking a look at the sheet itself, you want to give that one more click. Basically, what we saw was that growth funds were at the bottom and the value-oriented funds were at the top. And for the fourth quarter, basically what we want to do is do a deeper dive and see what happened to this growth area. And we saw that using the Lipper active indices, that the information technology sector was responsible for about 170 basis points of loss for large cap funds. And when we dug down even deeper, we found that 171 basis points, so all of that was actually due to Apple. Of course, there's off and on a whole bunch of funds that did well and a whole bunch of funds that did poorly, or stocks, I should say. But overall, when we took a look at the active indices, the information technology was really the drag that sent everybody down to the bottom on this particular graph. So taking a look going into our fourth quarter as well and looking at our 4x3 matrices, obviously small cap funds came into favor, up 2.29%, and value also came into favor, 2.47%. And there was about 291 basis points separating value and growth for this particular period of time, and that's a pretty big chunk to be saving on. And again, we can attribute most of this to poor performance from the growth sector, in particular the large cap sector. So we saw the poorest performance at large cap, returning 0.01, but on the growth side, minus 1.01% return. If we take a look now at the monthly returns, we have basically the same picture. Value funds that did better than their growth counterparts. The small caps did better than their large cap counterparts, but again, at least they're all in positive territories. What we did is took a deeper look using active indices again, and small cap value funds, by their weighting and relative performance, industrial sector stocks actually helped hold up this group, so that would be small cap values, up 1.05% of their performance, and financial services or financial sector stocks added about 0.83% to their performance. So really, when we're taking a look at value, the two areas of interest were industrial and financials, and I think that's a theme we see throughout the global market as well as the domestic market as well. So, tax concerns really, I think, had a pretty big impact on the precious metals. People say, well, why did precious metal funds do worse, gold miners and the like? And I think it had to do with actually, when we get down to the precious metals, the physical holding, and the idea that the capital gains would be treated differently, and they were fearful that there would be a rise in interest rates. So I think for sector equity funds, a lot of this was selling your winners, getting rid of some of the winners, and worrying about some of the tax implications, caused by the fiscal cliff. Also, there was a demand issue as well for some of the commodity stocks, as I talked about, and we had bumper harvests in both the coffee beans and sugar in Brazil, and is it Arabica? Arabica coffee bean actually had a loss of about 37% in their futures market, again, due to this bumper crop that I was talking about. So one of the things that we saw that was consistent throughout the quarter was this bit that basically commodity funds got crushed. Gold-oriented funds were down 12.49%, commodity precious metals down 7.55%, and again, commodity agriculture down 6.62%. But on the flip side, this global trend in investing, people still looking for out-of-favor stocks and dividend payers. International real estate funds up 9.78%, global financial service funds up 8.55%, and the industrial funds up 7.60%. This industrial move and the basic materials move makes total sense to me, by the way, with China coming out and saying, listen, we're having better factory orders, and by their purchasing manager index. So people are a little bit more encouraged that some of the first stages may start increasing. In December, sector equity funds was the second best performing group, and again, we saw at the top, global financial services out of favor and interest paying, and then also basic materials I just mentioned as well, at 5.15%. And then it is one of the lower performing groups, only surpassing mixed asset funds year to date, but still up 11.46%. Definitely, I don't think anything to be disappointed about. Again, people were seeing buy-in opportunities in one part of this group, and seeing, again, pressure from weakening demand and tax concerns for another part of the group. Take a look at the slide again. At the bottom, we have commodity funds. At the very bottom, and I didn't mention in December, with 5 of the 6 really bad performers were commodity funds, and the other one was precious metal equity funds. So this continues on as well, and we can see this in the bottom of this graph as well, that the commodity funds were at the bottom, and the out-of-favor international dividend payers were at the top, international real estate, global financial services, and the like. So the world equity funds, people really focused on the international. They did in Q1, they did in Q3, and they did again in Q4. Basically, what we saw was that international stocks were coming, and they rallied off multi-year lows on buying opportunities. So we saw the world equity funds up 5.45%, ranked number 1 in not only the quarter, but in the month and also in the year. For the year, they returned 17.66%, and they were at the top of the leaderboard for the first time since 2009. I think a lot of people think that because of the steady Freddy appearance of world equity funds, that in fact they've been winners in each and every year ever since the 2008 debacle that we went through. But that was not true, and in fact this was their strongest period of time that we've seen in the last several years since 2009 as well. So one of the things that we pointed out a little bit earlier, we think this is obviously due to the concerted efforts from the central banks, particularly the ECB and the Bank of China, and again I mentioned the weakening of the dollar. So this had to play, I think, for the entire month and for the entire quarter into the roles of how well this particular group did. China region funds were up 10.81%, European region funds up 7.66%, and Pacific region funds, these are out of favor classifications, at least from prior quarters, up 7.33%. And again, what a lovely year it was as well. So we'll go ahead and move on to the 3x3 matrices. This is again just for the quarter. First one, the top one, is the International Diversified Equity Funds, and the second one is the Global Diversified Equity Funds. Both had similar traits. A little bit out of favor of what they had about what they did with the USD funds. Basically, they were small and mid cap, but basically value. This is large cap and value oriented, and this is pretty much where it stayed. And what we saw the movement to was, again, people favoring, again, the larger issues and value issues as well. So as we turn on to the next sheet, we're looking at the world equity funds, and again, out of favor funds were really where it was at. China region funds, European region funds, and Pacific region funds doing the best. And at the bottom of the group, again, nobody actually posted negative returns for this group at all. So India region funds at the bottom, they struggled. There was some government issues that were going on that were certainly resolved, and global equity income was just a laggard as well. But if we look at the other guys at the top, basically it's international and country specific, and at the bottom it's those global funds containing a little bit of U.S. Focused group as well. So the last piece that I'm going to talk about is basically our mixed asset funds. Our mixed asset funds did pretty well for Q4, up 1.33%, for December 1.17%, and for the year, this is actually remarkable, 11.15%, very strong. One thing I like to bring up each and every time, first of all, let me start at the bottom. Flexible portfolio funds were up 0.17%, and the max return at 2045 was up 2.18%. For the quarter. But one of the things I like to bring up is the flows, and this is a little bit different than the flows that Matt's looking at. It's first of all only mutual funds, excluding ETFs, and secondly only runs through to November. But if we take a look at it, mixed asset funds drew in $109.1 billion. USD funds on the other side lost 107. Sector equity funds took in 6.1, and world equity funds took in 12.7. So overall, the steady Freddy, the big draw for investors as they were, basically ducking for cover over the last quarter and really over the last year, was mixed asset funds took in a large portion, the steady Freddies, and again, set it and forget it, really worked, 109. So total for this group through November, year to date, we only saw about $20.9 billion in net new money come into the conventional fund business, and again, the lion's share, if not all of it just about, was due to the mixed asset group. Well, that brings me to my final piece, kind of what's ahead, and this is one of those pieces where I kind of repeat myself quite a bit. Non-farm payrolls up 155 versus 152 here in December. The November payrolls that came out, actually, I'm sorry, December payrolls came out in January. That really should be around 300K. And I think that's a problem. So we're going to have this kind of slow, lingering growth, but you want something? It's slow and it's growth, and that's okay. It beats the alternative. Global, European debt and the recession will be a drag, and you got to remember, even if China's starting to peek its head out and starting to maybe get a 7 or 8% growth rate, one of their big importers, one of their big clients is Europe. And so if Europe becomes a drag and they're kind of slowing things down, that could be a drag on the economy as well. So it concerns me. Another big concern is, of the issues that were being discussed with this fiscal cliff issue, was basically there was no spending cuts. So there was no resolution there at all. So we came up with a little bit about taxes, and who would be taxed, but we really came up with no decision on spending cuts. And so despite their best efforts to derail the economy, our government officials basically were ignored, and people kept on trucking their merry old way. But we also now have to be concerned about our U.S. debt ceiling being discussed in February. That's a big issue. And again, we enter an area of more uncertainty, and that kind of could be some problematic things for the market. Continued subpar growth, as I just mentioned, and tech slowdown. Will this piece about Apple and Google and Microsoft and the rest, will that carry on or go forward? Actually, here in the new year, Apple's done okay. but certainly something that we should keep a look on. Again, non-farm payrolls, we're doing pretty good, 7.8% unemployment rate. Actually, I think it's 7.7 now, isn't it? But anyways, 7.8, 7.7% unemployment rate, my error there. But also we had some really good numbers. December ISM, non-manufacturing number index, was up 56.1. ISM manufacturing index rose for, up to 50.7, which by the way is expansionary rather than contractionary. We had improved factory activity in China. Housing market is showing signs of improvement. I mean, when we take a look at that, basically on I think it was December 27th, the single-family homes rose 4.4% in November. And when you have new home sales increasing, that is kind of the last piece of the puzzle to put things together that the housing market has turned around. So this is really good. QE3 obviously is working, whether people liked it or not, but QE3 seems to be working. And globally, the central banks are working together to make sure, and by the way, forcing us towards riskier assets. So I think overall, I don't expect a very strong 2013, but I expect a positive 2013 in selective areas for equities. Well, that's it for me. I'm going to go ahead and hand off to Jeff, and if you have any questions, please send them in via our chat feature. Thanks so much.